Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Don Calcagni, Chief Investment Officer of Mercer Advisors, to discuss if the 60/40 portfolio model is dead and why investors are moving into alternatives. Don, it's great to see you as always. Welcome back to Trade Talks.
Jill, thank you. It's great to be here.
All right, you got it. Before we get to portfolios, let's talk macro for a bit. Of course, all eyes on the FOMC next week. Will they or won't they raise rates in September?
Yeah, our base case is that they're not going to raise rates, Jill, although we would argue that given the CPI report from earlier this week, that the probability of a rate hike has inched up a little bit. It's inched up a little bit more for perhaps a rate hike in November, but still our base case is that the Fed is not going to raise rates, probably not until November or even into early next year.
Well, I guess the key question is, when will the Fed begin to cut rates? What do they need to see in terms of data that their strategy is working?
I think the Fed wants to see shelter come in. I think they want to see core come in a little bit more. I do think the Fed is going to look past what we're seeing in terms of energy. We're seeing an uptick in energy-related inflation that's mostly due to the Saudis and the broader OPEC cuts that have been announced recently. But in terms of future rate cuts, our view is that we're probably not going to see the Fed seriously consider rate cuts until probably about June of next year. But we would caution there's a lot of noise around that prediction. The reality is there's really no need for the Fed to cut rates unless the economy were to run into some challenges. And at the moment, by most measures, the economy looks like it's just fine, regardless of the different metrics that we look at.
Let's talk about fixed income for a moment, given the inverted yield curve. Should investors begin adding back duration to their portfolios?
We think that makes sense. Our investment committee voted several months ago to slowly begin adding back duration to our fixed income portfolios. We think it makes sense because we think the Fed is towards the end of their rate hiking cycle. They may not be done. There may still be another quarter point in there somewhere, like I said a few moments ago. But we're closer to the end of the Fed's rate hiking cycle than we were the beginning. And we do think that there's an opportunity here for investors to start hedging some of that reinvestment risk in their fixed income portfolios. We would also argue that this really isn't a market where you really want to try to be a hero. We think going out 4, 5, 6 years in duration is more than enough given where the current yield curve is.
And I want to talk about the rally in technology for 2023 up until the past couple of weeks, where we've seen some sector rotation that really has been what's been leading the market here. Do you think that's been overdone, or is it just right?
We think it's a bit overdone. I mean, if you look at the valuations of the top 10 companies right now in the S&P, they're trading at close to 30 times earnings. And if you really think about what that means, Jill, is that for every dollar you pay for shares in those companies, you're only getting back about 3% in earnings. And when you compare that to value stocks or non-US stocks, where you're getting 5, 6, 7, sometimes even 8% in earnings yield, we think that that's really overdone. I think anyone today who's investing in technology, investing in those top 10 stocks, you're really banking on the promise of very, very substantial future earnings growth. And I would argue that earnings growth is still TBD. So I think the more conservative play, tilt the portfolio towards value stocks and underweight those very growthy tech names at the moment.
And the depth of the 60/40 portfolio, we're seeing investors move into alternatives. Do you think the portfolio model is dead when you think about 60/40?
You know, we don't think it's dead. Folks have been writing the obituary of the 60/40 portfolio for a long time. And certainly last year was its most difficult challenge yet. And again, no surprises, the Fed rapidly raised interest rates. But what I would argue is if the 60/40 portfolio was dead last year, then that means it's come back to life because rates now are significantly higher. You know, back to the earnings yield analogy a second ago, you know, treasuries are yielding 5.5%. If you're buying those growth stocks in the market right now, you're only earning about 3% in earnings yield on those companies. So interest rates are higher. That means the 40% allocation of fixed income in a 60/40 is now doing much better. So we don't think it's dead. Now, we do think it can be improved upon and that there is a significant opportunity for investors to add the right types of alternative investments to their portfolios. we would caution against investing in very expensive, perhaps liquid alternative solutions. This is a market where certainly there's a lot of firms trying to sell liquid alts types products. We think investors should really proceed with extreme caution. We like private equity. We like venture capital. We also like private credit. We think those are markets where investors can add some accretive value to their portfolios in terms of alpha and increased diversification.
All right, Don, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Great. Thank you, Joe.